Hey guys, what's happening and welcome back to yet another YouTube video. So today's video is about risk FX pairs. This is vital for all FX and currency traders and all traders in general. I want to say a massive thank you for people that have watched the past two videos about dollar bulls and S&P 500 madness. Now guys, as you're noticing, we're doing more and more macro videos on this channel. This is something that I believe 98% of traders do not know or do not understand. This is vital when you're trading the financial markets. So go ahead. Link on the bio for my website. We've got a simple course on there that teaches you everything when it comes to fundamentals. Plus me and my team every single morning for 20 minutes break down and condense all the macro information you need to know for that day before you start trading. So let's get to it. Risk pairs. So guys, what is a risk pair? Now this is any pair that is closely tied to commodities, and that's why we call it a risk pair. This includes Aussie dollar, Canadian dollar, Norwegian krone, Swedish krona, and even a little bit of Mexican peso. On the other hand, guys, we have to match them up with commodities that might be based on a lower yield. That's right. We even take into consideration currencies yields when we choose which kind of risk pairs we want to trade. Now, if a currency has a lower yield, we could find often they are what we refer to as funders. I always call them funders. And this could be, for example, the yen, which I believe is 0.1% negative yield. That's right. You put your money there, it's costing you to put it there. On the other hand, we have higher yielding currency pairs, which bear a lot more risk. But again, this is where carry comes in. And this is very important to listen to. So now, guys, we're going to pair the two up. Some of the best FX risk pairs in which you take the currency associated with commodities, and then you go ahead and pair it with a funder. Now let's break this down for you. Risk currency, one is closely tied to iron ore, which is Aussie dollar. On the other hand, we're going to choose the yen. And you can also choose the Swiss Franc, but for this example, let's choose the yen. So for myself, I'd actually rather choose the yen, guys, as I was actually there when I first actually got into trading, where the Swiss National Bank depegged itself from the currency. And basically, I was going for a lot back then. And I was trading with a pari, which actually closed down. So yeah, I'd rather stick to yen as a lender. Now, let's talk about Aussie yen. Now, this is one of the most important risk FX pairs and also one of my favorite ones to trade on a daily basis and look at overall when it comes to determining risk tone. If you're looking into that some more, you can look at other risk pairs included. Like, for example, you can throw the Canadian dollar in there because of its relationship with oil. Now, if you take CAD, and again, let's add that funder on there, you have CAD yen. Now this provides a very similar outlook to Aussie yen because of how much of an oil brings into this risk bias. So guys, I'd actually throw a bit of pound yen in the mix as well. Why? It's not really tied to commodities, but it does carry a lot of risk. And this is actually something I actually learned a few years ago, which is pound is 1.5 times more volatile than the euro. And then this is why we get into trading, guys, because we all love volatility. So right guys, the next thing I need to go through, which is very important, it's not all about commodities. Risk pairs, let's give risk pairs steroids, throw some acid in there, throw some drugs in there, some bad politics. That's emerging markets. And that's what brings carry, what we call carry. Buying that currency pair, you get a huge yield from it, but again, it comes with a lot of risk. So if you want to take one of the yen pairs and commodities and just amplify it, let's take Aussie and CAD, which we've mentioned, times it by 10, guys. That's right. Emerging market traders are actually a bit crazy. And actually, my hat's off to them because I'm not brave enough to dabble in it. But those that are is great. And that's why I look at emerging markets every single day. You're carrying FX risk. You're carrying a bit of carry. Equal madness. So one of the other things I look at is dollar ZAR. Now, dollar ZAR, again, second fact number 2. It's actually 225 times more volatile than euro dollar. That's right. 225. So I often look at dollar ZAR, again, with my big list of emerging markets to see what kind of price action we're looking at. And sometimes I'll see a move on the emerging markets on an average day will be bigger than Brexit. And I'll actually show you that in a quick minute as well. So here we are with pound dollar. And I'm actually going to show you an example, which is to do with the Brexit, and show you the massive difference of what happens on a lending pair, a risk pair, and then of course, normal cable. So on normal cable, as you guys can see back here, we all witnessed Brexit together. So if I were to go ahead and measure this price range, we can see that this was roughly, I call it a 3,000 pip move to the downside, which was huge. Now, if I actually go on to pound yen, I'm actually going to go ahead and again go back all the way to the exact same move. Look what you're going to see. The exact same move was nearly 7,000 pips. Now, what was the difference here, guys? Because Brexit was Brexit. But the difference was that we're dealing with a lender, which is yen. And that's why if when trading lenders versus commodity pairs or lenders in general, it's always nice to know that they carry with them higher volatility. And so if you think that a 3,000 pip move compared to a 7,000 pip move is crazy, let's look at US Russian ruble. Now, guys, I only have to count the pips for you guys here, but as you guys can see, this as an emerging market is an extremely tough pair to trade. As I mentioned, people trade these because of carry. People trade these to try and see how the yield will perform for them after a year. And also, I was mentioning dollar Mexican peso as well. And as you guys can see, forget Brexit. Sometimes some of these emerging markets, they can move on so many different variables and they can move absolute crazy. So they're very hard to trade. So this is why I give so much respect to emerging market traders. So secondly, I will look at dollar Mexican peso. And as I mentioned earlier, I would also consider Mexican peso as a slight risk currency based pair because it's got a good proxy when it comes to both Argentina and oil. Now, try and put that into the emerging markets. It creates this absolute chaos. Now you guys may be wondering, why are we even looking at this? Well, if you look at the dollar ruble, which I've been looking at in the last video as well on YouTube, you can see it's actually showing us what's exactly happening out there with the wars and tensions between Russia and Ukraine. Russia has its finger, guys, in basically everything from oil to gas to just general politics. So both looking at commodity-based pairs as well as emerging market pairs, we get a good view on what the dollar's doing. It's almost a barometer for risk for your average trading day. So guys, what we have actually here is a commodity index. Now this is very important. And again, I look at this as a CRB index, which is a core commodity index. And as you guys can see, inside of this will be stuff like oil. It'll be equities, which is huge risk. It'll be junk bonds, which carry a very high yield credit. You also look at 2-year. The reason we look at 2-year yield is because it's very sensitive to the Fed and interest rates as well. And as you guys can see, the brown line that we actually have going across the top, that's COVID. And as you guys can see, this was an insane performance this year because of COVID. And they look at the effects because of oil. And again, this will then relate to Aussie dollar. This will relate to CAD. This will relate to NOK. This will relate to SEK. And this is, again, the counter for this for the Federal Reserve will be dollar hikes. So really you have commodities versus yen or franc, Swiss franc, depends on what you want to look at. And then you've got to consider carry when it comes to everything. So this is an important chart, guys. Just keep in mind, it's called the CRB index. You can just glance at it if you want to learn more about how risk FX works.